the FTP funds transfer pricing sessions. And last time we spoke about the curve construct. This is the continuation. And today I wanted to show you another example of how to set up the FTP curve when we have the mixture in terms of funding between retail, so NMDs and FTDs, and the wholesale funding markets. So of course, you can imagine that it will be blended FTP curve if you want to consider also the fact that you are funded by deposits, so retail deposits. Usually it is reflected in the curve construct, but it was not always the case. So why it has started to be reflected in the FTP curve? Some time ago, banks used to move towards asset momentum. So there was a lot of growth on the asset side. So we had this kind of the model when the assets were growing, increasing, exponential growth. And the question was, how do we fund this? From where to take funding to cover this growth? So the only way to do it was through the additional capital market. So you had your deposit base, plus you wanted to fast, easy, a cheaper potentially cost if you wanted to have the to run the maturity transformation, of course, the lower terms on the wholesale curve could be, especially if you are borrowing for the shorter time, on the shorter tenor, I mean, then of course it would be cheaper. Meanwhile, as we know, the FTDs, longer term FTDs could be expensive. So meanwhile, if you go longer, of course, if we start talking about funding through bonds, funding, on the longer end of the curve, then of course it becomes expensive, and we know that. So it was portion of funding this through capital market, this capital market funding, which was desperately, let's say, by the bank used to cover this additional growth. So then, in order to reflect this marginal additional cost of funding, which needs to be passed on the asset side, there were setting the curve based on this senior debt issuances. And I will show you soon the case study when the bank was using exactly, especially on the medium long end of the curve, they were using this additional issuances in terms of bonds. So for longer tenor, they were funding the balance sheet through issuance in bonds by in 1 tenor, 1 year tenor, 2 year tenor, and so on and so forth. But then we know that with COVID and with the low rate environment, we had the situation where we faced growth of deposits. And the reason for this, and the bank started to, slow down the growth on the asset side, and also after the financial crisis, they started to be more cautious about what type of asset they want to have on the balance sheet. And obviously this is justifiable because they didn't want to run too much of credit risk, especially because of the uncertainty. They learned the lesson. Also, the regulatory requirements changed. We faced the heavy regulatory landscape. Therefore, banks also changed their funding, structure and the asset side. So basically, given that at that point, deposits were available and they were flooded into bank because, of course, there were nowhere else to go. So the rates were very low. Where do you go? Do you go in the long-term FTDs, knowing that there is the uncertainty and you will be fixing this low rate for long time, for 5 years, for potentially 4 years or 3 years? No, you will place the money on your current accounts or savings account, CASA, and you will wait until there is better situation in terms of normalized rates, interest rates, and you will get better return on this. And indeed, during the low rate environment, we know that there was the term which was surge deposits. So deposits which were on the balance sheet only because they were waiting for the better opportunity. And indeed, as far as rates started to go up, those depositors moved immediately elsewhere where they had better rate opportunity. And especially they moved to the FTDs, the product which is fixed term deposit, which is offering much better remuneration. Those customers are known as, they will be shopping for the better rate, and how to reflect in FTP this changing, situation, the fact that we have more, slowdown in the asset origination, and at the same time you have those NMDs piling up in the balance sheet. So this model, you agree with me, is changing completely the structure of funding. So Treasury will obviously have a lot of fund or a lot of excess funding, and they will probably face the question, I cannot lend it because I have limited class of asset I can lend into, but I can maybe invest this through treasury book, through HQLA, high quality liquid assets, and can try some investment strategies to have the better opportunity, rather than hold this cash at the central bank reserve with a very low rate and remuneration, therefore. And this was indeed the situation which was faced, and we know that exactly this was the starting point of the Silicon Valley Bank story, when they faced a lot of deposit flows in times slightly before COVID and after COVID. They were faced by flooding, free cash, which was placed on the balance sheet. And this was because the situation was, where to else to go. So there was no other opportunities. And then we face the situation, which is when the rate starts moving up, another situation. So you are obviously now, you can gain by HQLA, and many cases banks were trying to optimize the fact that the free liquidity on the reserve account really remunerated very good rate in the higher rates environment. Sometimes you even run the positive cost of carry, so which means that the remuneration on the LAB, liquid asset buffer, is better than the cost of the funding of this LAB. So especially if you're funding it through NMDs. So again, this was one important point in this kind of strategy, especially for Treasury, because LAB started to make money for Treasury. It was not anymore the negative cost of carry like it was in the times of COVID and low rates environment. This was the P&L drag. Now it's not the case anymore. Now we know that when the rates started to move up, and then for 3 years they were at this higher level, we know that there was the situation, opportunity, which many banks took advantage of. But still, you have deposits, you need to remunerate, you need to pass through on the customers, especially on the customers which are holding savings accounts and they want to get some decent remuneration on those accounts. So they will leave if you won't price them up in line with the central bank rate increase. So this is what we call pass-through rate. And the reason why I'm introducing this term is because it will be very important to understand how to create the FTP curve for this kind of situation when we have very rate sensitive customers and they are not anymore core, everything core, because this won't be the case. These customers are very sensitive. They will be fluctuating if you don't pass through, if you don't set up the correct beta, correct pass-through rate for those clients, then you will lose them. So it's also some kind of trying to find the trade-off rate for those deposits, which is not to lose them. So you need to pass through certain increase of the central bank, but at the same time you don't want to overpay, because of course you will there is always domino effect. So if you start passing, higher and higher rates without consideration of external deposit market, this could lead to this artificial high price in the market, because the competitors, in order to gain funding, they will need also to, to pass higher rate to stay aligned with your level. So of course we don't want, as a treasury, we don't want to see this pricing war between us, between different banks, especially banks which are fighting for funding, and we will try to set up this optimal beta, so optimal level of rates which is in the middle. So we give to customer the portion of the rate, central rate increase, but at the same time we don't want to trigger any war with other banks in terms of jumping higher and higher. So for this kind of situation, definitely you will have another model of FTP curve construct. And I want to also show you this model, not obviously model itself in details, but I will show you the situation, because of course all models, all details are shown during the FTP course, which I'm running, and so I'm not allowed here to show any models and any details, but I can tell you what is the content of these courses, and of course here I will show you something as well. So first of all, let's start with the situation where we have a portion of wholesale funding, and we have, because we are also active on the capital market, we have important retail funding base, which we know that we need to include in our FTP curve construct. And we will try to find the composition of funding structure by each tenor, by each time bucket. So the situation is similar to the one when we were creating the FTP curve only based on the deposits, so funding through NMDs and FTDs. Here we will be also including this wholesale funding, so very similar model and very similar approach, which we described in the previous session. But here, by each time bucket, you will be designing or calibrating the proportion of different sources of funding. So the wholesale funding portion and the retail funding portion. And obviously this calibration, as you will there will be some kind of amortization or attrition profile for your retail funding portion, so that you can fill in the gap through this wholesale funding portion, because we know that we can. So basically it answered the question, how do I found an asset with 1 year tenor? So for 1 year, if I lend money for 1 year, I will be funding this through 60% retail funding and 40% of wholesale funding. Then the longer tenor, of course, these proportions are changing because you have lower reliance on retail funding portion. So in this case, it will be 55%, and it will increase, your wholesale funding portion will increase instead. Because your reliance on those longer tenors is growing, because here you don't include the new business. When you set up the FTP curve, you look at your attrition amortization profile of your deposit base. So this is why it's going down. Of course, if you assume that the average life of this product is, let's say, it goes down up to 10 years, so it will be completely, by the end of year 10, it will be zero in terms of the retail funding, because your average life of the product is 5 years in this situation. Of course, example, it could be lower, it could be higher. We know that regulator now started to look closely what is your behavioralization, so extent of behavioral or modeling those NMDs until long tenors, because it's, it's easy to model them long term and to close your time bucket sensitivity and to go with natural hedging. But if it's wrong, the model assumptions are wrong, your balance sheet will be unhedged, especially if you have the fixed term assets, and your time bucket sensitivity will be much higher than you are showing, because you are showing that everything is closed through NMDs. Meanwhile, it's not the case in the real life. So yeah, just wanted to clarify this, that it is amortization profile, which each bank has their own model, amortization. Also, we call it mortality ratio analysis. So you are analyzing how fast your stock is declining, how fast it is reduced over time. And this is important to notice, because this is the start of this analysis. Because you can ask me, how do you set it up? You are showing me here it's 60-40 and so on and so forth, but how practically I will apply this in my bank? So you need to start with the mortality ratio analysis for your deposits. Of course, you must have this kind of model, because you are modeling NMDs for FTP, for IRBB, for liquidity purposes. So everyone use the behavioral view for management of these ILM risks. So therefore, you will be modeling them across. And only then you will be, like I said, filling in the gap through this wholesale funding portion. So only in this way you will be able to calibrate, the cost of your 1 year wholesale funding and the cost of your retail funding portion, and your blended rate for each time bucket will be 60% in this particular 1 year case. It will be, your FTP will be equal to 60% multiplied by cost of funding of 1 year, of course, through your retail funding portion, and 40 through your wholesale funding portion. So you need to find, obviously, for 1 year. So this is the differentiation by tenor, because how much you have for 1 year is not the number how much you have for the 2 years. So therefore you see that with this amortization profile, your longer tenors will be higher because this cost will be higher than deposit base. Usually, if you talk about longer end, if you have long-term NMDs, it means that they are much cheaper than the cost of the wholesale bonds for long-term period. So the farther you go across that curve, the higher higher FTP will be. So just to summarize, it is also written here, it answered the question of what the funding proportions should be to fund the asset for 2 years, 3 years or more. In the short term, the FTP is very close to the retail funding cost, since the stability of the retail deposit is extremely high. In the medium term, the FTP is affected by both retail and wholesale funding condition according to the empirical stability of the retail deposit. And finally, in the long term, the FTP is closer to the wholesale funding cost since the stability of retail deposit cannot be assumed as given. So this is what we said. The longer we go, the the higher the mortality ratio across your cohort, NMD's cohort. However, the bank still benefits from the attrition dynamic, so you have this, dampener of the whole FTP curve. You are lowering the FTP curve through this 35% of retail funding portion over 6 years, for example. So this is important if you take into account also the NMDs, because you are lowering the curve, and obviously this is fair because this is exactly how you fund your balance sheet. So now we know that NMDs, your FTDs is important portion of your funding, and banks need to optimize the funding composition to be profitable. Without funding optimization, you can, kill the business because you don't have the proper funding strategy in place. So this is very important why now Treasury started to build this FTP based on also NMD. So not only the wholesale funding curve, which I show you, but also this kind of blended FTP curve. So this is the model which is now the most common one because it reflects the fact that actually, first of all, banks are not geared towards asset momentum. They are growing cautiously, so they know what kind of asset they are analyzing, what kind of asset they want. They are thinking deeply about funding strategy, and the FTP needs to reflect this more, more optimized model in terms of the balance sheet management. And by the end, our blended curve will be somewhere between this purely wholesale funding curve and retail funding curve. And you see will be lower. This green one is here the FTP curve in this particular example. I will finish here this session because the next time I want to walk you through the model which is based only on deposit, but is on the forward-looking basis. So let me explain, let me do small introduction to that before I just, go immediately with this model next time. Usually, FTP is set up or in the point of time. So it answers the question, how much today it will cost to found my asset, 1 year asset, or how much it will cost me to found 2 year asset today, or how much it will cost me to found 5 years, but it is today. So you are not looking historically. There is no historical view. You don't care about your historical cost of funds. This is very important for FTP. You are always think marginality. FTP is based on the marginality principle. So you today think how much it will cost me to found asset XYZ for tenor XYZ. So this is very important. But there is I've seen some models which at the beginning I was quite like, how does it work? Which there are pros and cons of those models, but effectively they are also quite strong pros. So they are based on they want to understand, because the point was, okay, Beata, today you are telling me how much it cost me to found 5 year asset. But, I am funding it today, but over the life of this 5 years, a lot can change in my funding strategy. And I would like to reflect. I don't want to, maybe today the cost is high because we are in the middle of the crisis in terms of the rates moving up, crisis in terms of mini budget, like mini budget in UK. And we have everything costs a lot. The deposit base is very expensive. So why should we pass on this asset or lock in this asset the FTP for 5 years at so high level? Is that right? So this was the question, which was the main question of people who were pro this new model, which is telling instead, let's analyze what will be today the view of the future also cost over the next 5 years. So you are looking forward. You are not only sitting today, but you are also analyzing the fact what will be the cost in the future across these 5 years. And this kind of mixture I want to price in today in this asset. I hope you enjoy this video. I will see you next week for another one, and we look in details, a bit more details about this model.